Today we are talking about options as a new stream of income. We'll talk about what that means, what we're going to do with it. My name is Scott. I will be your host. Let me know if you can see my screen and hear my voice. I haven't gotten any comments yet, so I just want to make sure that you guys are seeing and hearing. Yes. Okay. Perfect. Shazad, thank you. I appreciate that. Welcome out. Feel free to chime in, say hello, give me a comment, ask a question, and see where it puts us. I think I forgot to tell everybody on the trading room that this was happening. So that's my bad. I feel bad now. Okay. Well, welcome out. My name is Scott Beck. I'm the head trading coach here at Tradespoon. I'll be your host for today for the Thanksgiving extravaganza on options as a stream of income. I have been trading for over 20 years. I've been teaching, mentoring, coaching for the past actually going on 18 years. I need to remind you very specifically that trading and options in particular can involve substantial risk and may not be suitable for all investors. Please read characteristics and risk of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risk, be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team of Tradespoon may have a financial interest in the securities presented on the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block of FINRA. An SIPC member broker-dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay, please explain numbers and logic behind call or put spread. Well, Bill Coran, I hope I'm saying your name correctly. That's exactly what we're talking about. So let's talk about options as income. I mean, at the end of the day, you know, when you talk about options, you have the ability to enter as a buyer, you have the ability to enter as a seller, you have the ability to do a combination of the two, which then creates things like spreads, vertical spreads, calendar spreads, diagonal spreads, iron condors, butterflies. There's a lot of different ways to go about building different options trades. When we talk about options, I'm going to pull up a platform here. When we talk about options as income, it's a little bit of a, you gotta sort of parse that out, figure out what exactly do we mean by that. I mean, at the end of the day, I buy it, sell it, and if I make money, well, technically you could call that income. But in this regard, when we talk about options as income, we are usually talking about the concept of credit spreads at regular intervals, right? So when we do the trading rooms, we're oftentimes looking to identify strength and trend and find stocks that have pulled back, hitting support or resistance, and saying, okay, let's look to build a swing trade out of that. When you talk about options as income, we talk about income strategies, which would be selling naked puts, selling iron condors, selling credit spreads. Those would be the three most common. Iron condors is a neutral strategy. Although I'll tell you right now that in a low implied volatility environment, calendar spreads is a magical strategy, really strong for a low implied volatility market, which we're a little bit not there right now. Iron condors is more suited for a neutral strategy. So we're talking more about maybe naked puts, or in this case, we're going to be talking about credit spreads, right? Credit spreads, bull put spreads, bear call spreads. When you have a vertical spread, you're using two contracts of the same type meaning call or put, of the same expiration, right? They're both Decembers, they're both Januaries, but different strike prices. So Bill Coran asked, we buy a 468 and sell a 490, or right, we buy one, sell another. Different. The disparity is in the strike prices, and what it does is it creates a specific environment. Now, when I'm doing, I'll do credit spreads and debit spreads as part of my directional swing trading. Right, as a swing trader, I will absolutely take advantage of spreads, but I try to build them more in a favorable reward to risk ratio, right, where I can get 2 to 1, 3 to 1, and I'm willing to accept if I'm only right 50% of the time or a little less. This is what we're talking about today, where we're looking at credit spreads as a stream of income is a little different than that. I typically in that environment would build more of an at the money credit spread. When we talk about options as income, we're talking about out of the money credit spreads, out of the money bull put spreads. So we're looking to raise the probability of success. Now, of course, if you raise the probability of success, what's the pawn? What's the pawn? What are you sacrificing? You don't just get to raise the probability of success for nothing. Okay, what are we sacrificing? Reward to risk. Right? By going further out of the money. And we'll talk about, some of you might be thinking, Scott, I don't even know what a credit spread is. We're going to talk about that here in just a minute. I'm going to show you logistically how we build it, what our thought process is. But here's the first thing I'm going to say is what's most important about a spread trade is how you build it. At the money is going to be a bigger reward to risk ratio, but more likely to go wrong. That's going to be more of a swing trade mentality. Out of the money is going to be a higher probability, lower reward to risk ratio, an income strategy, meaning I'm looking to do it for a short period of time, 1 or 2 weeks. I get in, I'm just looking for that not to go against me. Now, if it does go against me, then I have to account for and worry about that lower reward to risk ratio. That's the pawn, right? That's the sacrifice in this game, is you're not going to be getting trades that you can put on for a week and get 3 to 1. It's not happening. We have to accept that. Quite honestly, you really have to prepare for 1 to something, 1 to 2, 1 to 3, and then you're looking to be right 70, 80% of the time, and willing to have a line in the sand that says, if it gets to this point, I'm going to close the trade. So let me know if you have any questions, but let's start off with this. Now, we have 2 types of credit spreads, bull put and bear call. Which one am I more likely to do? Ask the market. Don't ask me, ask the market. What am I more likely to do right now? Well, that depends on my posture overall in the market. Based on the Tradespoon model. So let me show you a couple of things that I'm going to use to type the wrong symbol, that I'm going to use to assess. Now you can see it's gone a little sideways, but overall, what's my trend? Up. It's consolidating a little sideways, but overall up. I look at the QQQ, the NASDAQ, what do I have? Same basic thing. I pull up charts. Here's a 3-year weekly chart. What's the trend? It's up. Right? This is the institutional perspective right here. What's the trend? It's up. It's bullish. We look at the 6-month chart. We had an uptrend. We had a little disruption here in August and September, but since October, nice big strong move. Now a little sideways, again, a consolidation, but what's the prevailing trend going into the consolidation? Up. Right? Up. More bullish. I go look at this cyclical model here, available in seasonal charts in Tradespoon, which gives me a 25-year composite. 25-year composite of what the market tends to do. Right now, it's running at an 88% correlation. What tends to happen at the end of November into December? A nice bullish push higher. That's part of our little Santa rally. So what would I be more inclined to do? I asked the market. The market said bullish. Bull put spreads. I'm not doing bear call spreads right now. Doing bull put spreads, finding bullish things, building some out of the money credit spreads, letting probability reign. That's what I'm looking for. Yeah? Okay, what is a bull put spread? A bull put spread, well, either spread, whether I'm doing a bull put or a bear call. So let's just talk about either one. Okay, in fact, I'm going to bring this up and let's see, what do we have on our list of things that we liked? Macy's, Netflix, Pfizer. Let's go through these. Now, what would help me with a trade like this? So some stocks that we found that we liked in our trading room just now. Macy's, nice strong stock. Volatility is pretty high there. Netflix, nice strong stock. Volatility is pretty good there. We actually just traded that last bounce there in November, and we traded the one in September. So we've had a good run with Netflix. So those are a couple of decent ones that we can look at. SWK is a nice retail stock. So these are stocks, strong groups, good options. Volatility's there. Let's see what Netflix does for us, right? Now, for a swing trade, and this actually would be a swing trade candidate. So I am using swing trade candidates, but really any trade that is in a situation like this is viable, right? I don't want to do it when it's in the down consolidation. I want to do it when it's moving up. I can stand to be a little late if I'm a little late, but the first thing is I want to make sure I'm in the right situation to put on a trade and see what's going to happen here. Now, what did I say? I'm not going to build an at the money spread. I'm going to build an out of the money spread. What does it start with? When you create a credit spread, you always want to start with the strike that you're going to sell, the short strike, right? Why is it short? You're selling something you didn't own. If you short stock, how do you do it? You borrow it from your broker, you sell it, and eventually you have to replace it. You're selling something you didn't own. Now here, we're not borrowing, we're creating. We're the writers of the contract in this situation. If I was doing an at the money spread, I would be selling something right around here, 655, but we're not doing that. We're going out of the money. So I might look at that next level down and say, what about 625? Can I sell a 625? Why? Because that's the next support. So even if it bounced up and then broke down, my thought is it would still come down here, and all I have to do is wait it out, week or two. That's it, a week or two. So I'm looking for this to be a probability trade. Yeah. So we will look at the probability model that's available here to understand it a little bit. But it starts with, what am I selling? So I say, oh, I'm going to sell the 625. Then what? I need to decide the width. I might go $5, sell the 625, buy the 620. I might go $10, sell the 625, buy the 615. Where am I going to do this? Well, I'm going to go into the Analyze tab here. I'm going to pull up Netflix. I'm going to go into the options. I'm going to say vertical spread now. And really, what am I looking for? I'm probably going to end up going the 10th, right? What do we have? We have tomorrow, Thursday's closed, Friday, half day. I don't know. Let's even see. Maybe we could do it here. And you can see there's not a lot of credit back here. Let's just jump up to the 6 to the 10th, or excuse me, the 3rd. So if I go out to 620, this is 630 by 625. Whoops, a little bit too much. And what is it going to look like? Looks something like this. So 630 by 625. So I didn't go all the way to 625, but I was pretty close. So I'm a good ways out of the money. Now, if we're talking about a probability trade, then we need to understand the probability. So I need this to stay above 630 between now and December 3rd. So I can go to the probability analysis. And I don't need that much time. I'll just leave about 45 days here. How does a probability analysis work? Well, it starts with it being basically, this is where we are right now. And what it's saying is there's a 50-50 chance it goes up or down. So the first thing and the first bit of comfort I take, I don't believe it's 50-50. I believe the fact that I have the trend in my favor actually takes whatever numbers I'm going to see here and even supports them a little bit more, right? A little bit more. Why? Because I believe that the fact that I have the trend gives me a probability factor that can't be quantified by a statistical model. Just keep that in mind, that when you look at a probability model, it's just like a coin toss. Right? It's just a coin toss. The expectations, I think, are higher when the probability is in my favor with trend. But what am I going to do? Well, this is the expirations. You'll notice these are each of one of these dotted lines here is an expiration for weekly options. We said we're going to skip this one. There wasn't enough premium. We're going to go here. And we said right around 630. Now, you'll notice that 630, if it's just the next few days, there's an 83% chance over the next 3 days it stays above. The problem is we didn't get enough premium, so we have to go a little further out. So now we come out here and we say, what are the odds it stays above 630? And you'll notice that right in here, the odds of it staying above 630 are about 73%. 73% chance that it stays above. Now, the problem is I'm only getting 95 cents on a $5 wide spread. So what have I done with this spread? So let's deconstruct this for those of you who maybe aren't as comfortable with spreads as you would like to be. So what am I doing here? I'm selling the 630 and I'm buying the 625. So it's not a naked put. Naked would be just sell the 630. You'll get a much bigger credit and you'll have a much larger margin requirement, right? My margin requirement is limited to the distance between the two strike prices. Now what's happening is the option that I'm selling decays at a faster rate than the option I'm buying. That gives me a positive theta. So I make money from time decay. I'm bullish on the stock and I have a bullish delta. So if you look at my delta is positive 53, which means if the market goes up, I make money. If it just stays the same, I lose money. No, I'm sorry. If it stays the same, I neither gain nor lose. So this is just a probability trade. 73% of the time. I can even adjust this down to 630 is where I'm going to put this. There's my intersection. And like I said, that is about it's about a 71. I said 73. I guess it means 71% chance. 71% chance of success. Now, what else can I do to help boost this trade or understand this trade is figure out my max loss and cut it in half. So if I come to this probability, max loss here says about 4,000, but I could basically look at this and say, okay, where would I have to get out of it to not lose that much? And you'll notice that right now, if it drops down and gets below 625, let's say, right? Remember we said we want it to stay above 625. If it breaks 625, I could get out of the trade and I would only lose about 1,500 bucks. Now 1,500 of loss compared to 1,000 of gain, which is about what I'm collecting on this trade, $95 10 times. $1,500 of loss compared to $1,000 of gain, 1.5. So 70% of the time I expect to be right and make 1. 30% of the time I might be wrong and lose 1,500. Now, the longer it takes, the more I have to kind of adjust my thought process, but that's part of dynamically managing the trade. That's a winning system right there. 70% of the time I make $1,000. 30% of the time I lose 1,500. What do I expect to make? Well, if we do this every week for 10 weeks, or maybe it takes a little longer, 15 weeks, at the end of 15 weeks, I would have 7 losing trades of $1,000, 3 losing trades of $4,500. At the end of that, I have a $2,500 profit. $2,500 of profit over 10 to 15 weeks. I'm making somewhere around $200 to $250 per week. And there's the income, right? We know we're not going to be right every time. This is, there's a lot of services out there that do these types of trades that lose people because they don't adequately prepare them for what if it goes wrong. First and foremost, I can't take that $4,000 loss, right? I don't ever want to, in a situation like this, be in a situation where I'm going to take a $4,000 loss. So I'm never going to ride this thing out and take max loss. I mean, it would have to go pretty far for you to get down there. But we do have to recognize danger points. So that is essentially the scenario that we're trying to build. Favorable reward to risk. You can see around this area. Once it breaks outside of this area, when it gets to that 625 or below, at that point, this trade has significantly altered its probability against us. And we're better off shutting it down. But this area here is where most people struggle. They think, oh, the probability was in my favor. It was, but it's not anymore, right? At this point, if it was at 625 and you looked at the model would say it's 50-50. And your loss potential is $2,500 more to the downside. So the first thing I would tell you, this is not a set it and forget it strategy, right? Yes, we have a lot of factors in our favor. The model is in my favor, right? It's looking for a bounce higher. I'm only in this trade until December 3rd. This is telling me that at December 3rd, it could be up near 700. If it's up near 700 around December the 3rd, I've made most of my money and I can just sit on it and wait and I've got max gain. That's it. I don't have to do anything. So if that happens, I don't have to do anything. The way I look at this trade, let me draw some pictures. Let me know if you have any questions about the construct. So here's where we're starting. This is the objective. It does what it's supposed to do and just bounces higher. However, we do have some leeway. And that leeway is definitely in this range here. It gets a little dicey in this range here. So I'm going to put this in orange and I'm going to take this maybe across right in this range here. We're like danger zone, right? It's a danger zone. And then we have this area here. We just can't, we have no interest in this. So this is how I want to manage this trade as I watch. Now remember, 6:30 in the next 10 days, remembering that tomorrow is a light day, Thursday is closed, Friday is a half day. I'm going to erase these numbers. And let's go back into these charts. So what do I need it to do? Stay above here. Stay above this level right here. Now, I would wait at least a day or two. In fact, I would actually look at this trade tomorrow, especially on a bullish day, and then let's see if we can't put it on and see what it rides for us. But that's it. This is a probability trade. We're saying the probability of it staying above 630 is it's going to happen 70% of the time. 70% of the time it stays in this range. And our expectation is it's going to push up here to this 690 level where we've seen it before, and that trade just makes money. So it's a numbers game. And if you're trading for income, right, you're not just cashing checks. You're basically saying, what strategies are there that I can look into that will I can put on at regular intervals. So now, typically, when we think of income strategies, we do think of vertical spreads, right? Vertical spreads. We build vertical spreads by selling the closer to the money strike, buying out of the money to protect us and to lower our margin requirement. We get a credit. We have a high probability that it stays there. We still have an exit strategy to close, and that's it. We do it over and over and over again, and we expect to be right approximately 70% of the time. We expect our winners to not even be as big as our losers, but they have to be within that 2/3 of a range, right? 1,000 to 1,500, 2/3 of a range. And I'm okay with that. Ideally, I'd like to see a 1-to-1 reward to risk ratio, but we have to be pragmatic about what it is we're getting into. And that would produce a positive expectancy. If you're not familiar with that concept, you should definitely look into it. But if I have 2/3 times 0.7 minus 0.3, it's not a great expectancy. Is that right? 2/3? 2/3 times. Yeah, I do definitely want it more like a 1, closer to a 1. I mean, 2/3 is okay, but if we're getting a little better, we should be able to get a 1-to-1 reward to risk ratio, maybe a little underneath. Let's say 0.8. 0.8 times 0.7 minus 0.3, 25% expectancy. That's what we're looking for right there. 25% expectancy for every dollar we put at risk. So in this situation, if we're risking $1,000, what are we expecting? $250. $250 on a weekly basis, right? Every week we're doing this trade. So in that situation, if I'm getting $250, now why would I be risking $1,000? Well, if I'm risking 2% on a $50,000 account, that's $1,000 on this strategy. $50,000 account, if I'm producing $250 a month, that is, or excuse me, $250 a week, that's $1,000 a month. That's a $12,000 income off of a $50,000 account. That's 24% return. Yeah, 24%. And that's a strategy that's only risking 2% at any given time. 2%, right? So if I had a couple of these that I'm doing, you can see the returns have some great potential. Great potential. Now remember, that 250 is not expecting that I'm right. That's acknowledging 70% winners, 30% losers. That's built into the expectancy. To be honest with you, even if the expectancy did drop to 16%, that's still $160 of income times 4. That's $640 a month. That's $76.80 on the yearly. On a $50,000 account, you're talking a 15% return. That's trading one stock at a time with 2% risk. So if I was doing 3 of those successfully, again, that's putting me up into a nice, highly profitable scenario. Let me know if you have any questions about those numbers, and I hopefully am throwing some concepts at you that you're going to look into for your own trading, which would be expectancy ratios. If you're looking to do an income, you're looking to do a trading strategy on regular intervals, which is what we're doing here, which means this is a numbers game. The risk, the reward, the probability, it's a numbers game, and we do it over and over and over and over and over and over and over. It's not a, hey, look, I've solved the market, I can always pick a winner. That's not what we're doing here at all. We're saying, hey, if we put all the probability into our favor, we can put together these trades where we think we can accomplish a 1-to-1 reward to risk with a 70% accuracy. We can devise an expectancy that's favorable, and we can put this together where this is producing on a regular basis. Every week? No, not necessarily. Most of the time, yes. Now, if the market, right now, I'm bullish, but if the market moves into a more of a neutral stance, then I'm going to be putting on both bull put spreads and bear call spreads. Let's go into monthly trader. I'm not, but if I were, I'd be able to come into the monthly trader, go into the bears. I'd be able to pull the bears up, and I'd say, now this is an oil stock, but it does look like it's rolling over. So let's just take, let's take IBM. IBM's on a downtrend, right? So let's pull up IBM. So I'm going to do one bull put and one bear call. So you can see this thing, every time it runs up a little bit, it rolls over. Right now, I would probably wait a little longer to see if it's going to get up here and turn. But let's say I have my signal. Where would I look to build this trade? Not at the money, out of the money. Maybe up here 125 by 130. So that, remember, what am I starting with? When we did the bull put spread, we said, where's the line in the sand we think it's going to stay above? Now we're doing a bear call spread. Where's the line in the sand we think it's going to stay below? So even if it came up a little bit and dropped, we'd be fine. So I start with the option I'm going to sell. There's my short strike. Then we look up here and we say, where's the protective? The 125, same thing, $5 of distance. Netflix was a $600 stock. Well, we can do the same thing here. We'll see what it looks like. But let's go in and let me erase these lines. And let's go into IBM. And let's go to still December's. And we said now we're doing bear call spreads. So we said selling the 120. Well, let's see if we can do 125. I don't know if that's going to be too far out of the money. Buying the 130. We're not sure yet where it's going to be. Yeah, not nearly enough credit. Let's go 120 by 125. Ooh, there is not much there. What's the implied volatility on this stock? Here you go. You can see, even though it's been coming down, the implied volatility is only 24%. There's not a lot of premium there. Let's go to Dominion Resources. Maybe that's a little better. No, not yet. I want probability, or I want volatility in there. Let me go to the weekly trader. And let me go into the bearish. It's quiet out there today. I know I'm missing a lot of my regulars who tend to chime in. So let me know how this is ringing with you. If it's making sense. Is this bears? Huh. I don't think this. Oh, there you go. Cardinal Health. Las Vegas. Okay, let's look at Cardinal Health. CAH. CAH. Cardinal Health. Oh, it's actually looking a little bullish today. Yeah, there's not a lot bearish out there right now. Roku and, all right. Thank you, Jeff. Let's take a look at Roku. Ooh, look at that, Jeff. Look at you come through. I like it. It's got the trend. So now TTD, I'm definitely more bullish on TTD. That's a nice strong surge. But let's take a look at Roku. Roku has, you can see it has some vol. Whoops. It's got some implied volatility down here is what I'm looking at, 60%. It's up near the higher end of the range. When we come into Roku and we build this, you're going to see a very different story by way of its range. Now, what would I do? Maybe try to go maybe at least halfway up this, 255. I could come into the analyze and I can look at the probability. Again, I don't need, I can go out about 45 days. I'm really looking here, December 3rd. And I'm saying, where is it going to be? 255 is up here. Oh yeah, you can see very much it's likely to stay below 255. I can even come closer than that. Let's say 250. At 250, I'm about 84% probability. Okay, let's see what we can get for it then. Okay, 250 by 255. Oh, see, I'm only getting 44 cents, but that's okay, right? That's okay because I have room to come down. Here's the 75% mark. That's around 240. At 240, I'm still at or above 70%, right? And that's kind of what I'm looking to do, is stay in that range where I have 70% probability. That's 74%. So I come down 240 by 245. There you go. Now I'm getting that 90-cent credit or close to it again. I have probability on my side. It's a week and a half. $235 is probably too much, so let's just stick with 240 by 245. Probability is on my side. If I go in, you'll notice it's the same thing, but to the other side now. So if it were to get out here to this area here, if it breaks above this level right here, 243, I might decide to shut her down because the probability will break at that point. My loss will be maybe 1,200. So you can see I'm around that 0.75, 0.8 reward to risk ratio. It's a numbers game. It's not a, oh, look, we're so convinced this is the perfect time to enter. We're not. We're saying that from where we are now, there is a 74% chance it stays below. 74%. Over what period of time? Week and a half. The longer it stays, the better. Now we're already bearish. So remember what we said. This is not accounting for trend. It is not accounting for predictions. Let's see what these predictions are. Roku. God, I used to love Roku. Roku was such a great stock for a while. Ooh, I don't know. Look at that. The model's kind of predicting something here. So you may decide, you know what, I'm not going to go against the model. I would want to see the model. We just kind of grabbed one. But this is definitely, just hopefully gives you an idea. What am I looking for? I'm looking for a list of stocks that I can count on here. What does that mean? High liquidity is essential, right? To be honest, if you're going to do this, you want to have a watch list of high liquidity stocks. You might even include ETFs where you can build the trade, not have to worry about earnings, get in, get out, make that money, call it a day. What am I looking for? Probability of 70% or higher. I'm looking to be able to, even if I had to close the trade, keep my loss, worst case scenario, less than 1.2 to 1 on my expected gain. I should expect to make money 70% of the time. I should get max gain 60% of the time and have a few trades where I may or may not get there. It's a numbers game over and over and over again. What are you doing? You're putting time on your side. You're theta positive. You're still also putting the trend on your side. So you're trading with the trend with positive time decay and with positive probability, and you're doing it over and over and over again. So these are credit spreads. You are selling out of the money. You are buying further out of the money. It doesn't have to be $5 wide. I just tend to give them some width like that. But at the end of the day, that is the strategy of turning options into income. If we're saying income, it has to be regular intervals. If you're swing trading, you're waiting for signals to set up, develop, and trigger. If you're doing income trading, you're doing it every week. You're finding something, you're putting it on, right? It's not necessarily this perfect setup. It's a setup that is the trends in your favor, the cycles in your favor. You have some volatility to help produce a little extra income out of it, and you're doing it weekly, and you're just doing number after number after number. So you might do 2 to 3 of these a week, and you're essentially saying, I expect to be right 70% of the time, and I'm expecting that my losers don't completely overwhelm. We're okay if your losers are bigger than your gains. We just don't want the losers to completely overwhelm it, meaning 1.2 to 1, which produces a 0.8 reward to risk ratio. And as long as we're maintaining that 70% expectancy, we should be producing a 20 to 25% expectancy. Now, do I have systems with a higher expectancy than that? Yes, I do. Do they have the frequency and the intervals that we have here? No. And that's part of the appeal of a system like this, is it's not just expectancy, but it's also frequency. Can I do this 2 or 3 times a week, every week, over and over and over? Now it becomes an income trade. So a lot of people will be like, oh, options as income. If it's not a regular interval, if it doesn't account for probability, if they aren't accounting for reward to risk ratio, if they aren't talking about what the expectancy might be, it's flawed, man. They haven't looked at everything. I'll tell you that right now. How about Microsoft and Peloton? We'll take a quick look. So there it is. That's the strategy. Let me know if you have any questions to wrap it up with. Microsoft, I would say bullish. It doesn't have a lot of vol. It's only in 25%. Definitely has a good trend. It would be worth a consideration. Peloton, I'd be looking at to the downside. It does have the vol. Would have been a beautiful and you know, we usually like to start somewhere in this, you know, right after a consolidation, right as it starts to move back down. Ideally, we're in the first 2 or 3 days of whatever cycle. If it's a downward trend, 2 or 3 days into the selling cycle. If it's an uptrend, like let's say in NVIDIA, somebody said, I'd like to catch it 2 or 3 days into the selling cycle. So this one right now is coming down. I'd like to wait for it to turn, but it does have vol. This is a candidate. It has good options. Peloton, same thing. There you go. There you go. There you go. All right. Well, listen, traders, it's good to see everybody. I will be back in 2 weeks. Is that right? Oh, it works out perfectly because the week after that, I will be gone and then I'll be back again. I will be back in 2 weeks for something. It'll be fun. It'll be informative. We'll have a good time. So I'll be here. Come on back. Appreciate you coming out. That's it. Have a very happy Thanksgiving. I hope you have a very safe and happy Thanksgiving. I will see you in 2 weeks. And as always, happy trading.